Welcome. My name is George Littlejohn from the CISI. And while people are filling the room, I'm just going to make the remark that Daniel is in God's favourite city, Glasgow, whence I come just about. And Urbina, my lovely colleague behind the screen here, who's making everything work technically, is also from Glasgow. So this is a trio here. Daniel is member number 89, we think, of the Institute, possibly number 86, but I'll come back to his career in a moment. But if we've got any members with smaller numbers than that, we will send you a cake. I think it's birthday time for those of you who've been members since the early days. The room is filling up. Thank you all for joining us on what is a sunny day here in London. Daniel Broby, very old friend. I've known him, I think, since before in fact, I know since before the Institute started. He's had a very distinguished career in investment management and wealth management, and now he's at Strathclyde University. And Daniel, if I may ask you to start with an explanation of what you do at Strathclyde and some of the exciting work happening there. But I'm not going to take any more time. One thing I always forget to do is to tell people to ask questions and answers in the Q&A box in the bottom right of your screen if you're watching on a laptop, and on the top line if you're watching on an iPad or your telephone. But Daniel, welcome. Thank you very much for doing this. It's much appreciated, and fire away.
Thank you, George. And just to sort of fill in on my background, I'm a director of the Centre for Financial Regulation and Innovation at Strathclyde University, and we're looking at advanced financial techniques and methods, particularly related to financial technology. But my specialist area of research is actually in investment benchmarks and indices, and as such, I'm going to talk to you about those today. So we're going to talk about selecting an appropriate investment benchmark. Picture of Strathclyde University there in the background. So a benchmark, according to the English dictionary, the Oxford English Dictionary, is a standardized tool that can be used as a point of reference. But it's easier to visualize, isn't it? So take a little look at the picture of the tent and the bear, and let me tell you a little story. So there are two fund managers out in the sticks camping because of COVID. They're about to go to sleep, and all of a sudden they hear a rustling outside the tent. They look at each other. One of the fund managers starts to put on his trainers. The other looks at him confused. "What are you doing?" He said, "Putting my trainers on." And he said, "Why?" And he said, "I think there's a bear out there." And the other looked at him, laughed, and he said, "You can't outrun a bear." Then the guy looked back at him and he said, "You know what? I don't need to outrun the bear. I need to outrun you." That is the essence of a benchmark. There are a whole lot of uses in a benchmark, but as you just heard, the most important is it being a reference point. But you can drill down that reference point into segments of sponsor's portfolio, for example, so you can get a better idea of what's going on throughout the portfolio. It's also used for communication. In that example, a communication that you had to outperform in the running away from a bear. But obviously in the terms of an investment portfolio, communication of actually what you need to achieve in order to deliver on the mandate's instructions. And those instructions come from board of directors or any other oversight group. One of those oversight groups being the consultants, investment consultants. Remember that as investment managers, we have what's called a fiduciary care. We have to look after our assets with the highest duty of care. Now, part of that, in a world where there's a mathematical trade-off between risk and return, is the identification and evaluation of portfolio risk exposures. And that's where the benchmark, if it's an index, comes into its own. And I'll go into that later. It allows you to look back over past performance as well. And this is very powerful. Remember, our industry is about data. We're creating performance and we're selling that performance and hopefully the expectation of future performance to potential clients. So benchmarks are used in that process. It's called the manager selection process. And to do that, it is used for appraisal. That means that you attribute the performance. You break down the performance into manageable lots. That obviously allows the marketing of these investment products, but also from a regulatory point of view, it demonstrates compliance with things like regulations, laws, and standards. So different from a benchmark is an index, and this is often confusing. But an index is a figure in a system or scale representing the average value of specified prices, shares, or other items compared with a reference figure. In other words, it is precise. So as I will come on to, you'll see that some benchmarks are not as precise as an index, and that's where the difference lies. Regardless of whether it's a benchmark or an index, all of the benchmarks have desirable properties. So the most desirable property is that it's unambiguous. In other words, that it's sending a clear message as to what should be in there or what is not in the portfolio. It should also be investable. There's no point setting a goal if that goal can't be achieved. It should be measurable. And this is very important, obviously, from an industry that is focused, as it is, on performance, which means that it has to be created in a frequent and timely basis. It should be appropriate, and in that respect, it should reflect the manager's style. And I'll come on to style, but clearly managers have got different styles. You have value managers, you have growth managers, and you have blend managers. You have large cap, mid cap, and small cap managers. It should also be reflective of current investment opinions. If you're fully in bonds rather than equities, you don't want to measure yourself against an equity index. Now, it needs to be specified in advance. You can't change the playing field after you've created it. It should also be accountable. In other words, what you can accept in there and what you can not accept in there. Now, all of these desirable benchmark properties can be found in a reading that I co-wrote with Professor Conover and Professor Carneiro in 2003, which is an introduction to benchmarks, which is a CIPM reading. So the benchmark types. Another set of academics, Bailey, Richards, and Tierney in 2007, listed what they considered to be the key benchmark types. The first of these is absolute. In other words, you just want to return positive performance, plus 1% a year, plus 2% a year, plus 3% a year, whatever. Or target return benchmarks. So target return, I want to beat CPI, inflation by 1%, 2%, or whatever. There are then the manager universes or peer groups. I want to beat my competitors because I want to sell my product more than they do. So therefore, I want to have a manager universe. The broad market indices are probably the ones you most likely recognize, the FTSEs, the Dow, the NASDAQ indices. These are the ones that cover entire markets with a very large coverage, from 75 to 95% coverage of the market capitalization. But obviously you can break down markets into all their different component slices, and you can even break them down into style. So there are style indices as well. And we're going to come back to all of these. And closely allied to style is factors, because within arbitrage pricing theory, you can break down the risk exposure in a market into factor risk exposures. And so with modern portfolio theory, we can go further and decompose these risks present in the marketplace. The flip side of risk is return, and you can also do what's called sharp style analysis. Again, I'll come back to that, but that's obviously a return-based benchmark metric. And of course, you can create your own benchmark. You can customize what you want so that it's more aligned to your investment goals. Of all of these is the broad indices that dominate. So let's take a look at the optimal versus the naive benchmark. Now there is a spider index web diagram, and I'll probably have to explain that a little bit. This is based upon my own research on each of those key attributes, whether it's objectives, rule-based, or whatever. And using a Likert score, the closer you are to the outside of that spider web diagram, the more attractive the benchmark is in that respect. So in this instance, The red benchmark attributes would be optimal. In other words, all of the Likert lines lie on each of the attributes for what an appropriate benchmark is. Coming to a naive benchmark, in other words, just essentially a portfolio that is poorly constructed and put together, you can see the blue lines in between show that actually it's only really the accessible instruments that really score highly on that, and that in fact this isn't an optimal benchmark. On the left-hand side of the screen, you'll see what we call a typical mean variant portfolio. Effectively, we're looking at an optimal portfolio line here, which is the efficient envelope. All the red dots below that line are inefficient portfolios, and the efficient portfolios lie on the black line. The optimal portfolio, for those who are doing more advanced portfolio work, is the tangent point between that line and the trade-off from the capital market line. So in terms of mean variance portfolios, the diagram there demonstrates what I have just explained. It's the red dot is that tangent point. That is the capital asset pricing model's representation of the market. And therefore, as a proxy, based on Markowitz principles, who wrote Modern Portfolio Theory, his thesis in 1952, that is the basis of modern broad market indices. So that's about as much as I'm going to go into the theory of what a broad market indice is, but needless to say, it's sound science, and actually what the CISI teaches. But just focusing on a mean variant portfolio doesn't necessarily mean that you've created the index as such. You still need to construct the index, and that construction requires a methodology. And the methodology can vary. And here, what I demonstrate is that if you have different methodologies with the same investment universe of shares, you end up with different outcomes over time. So actually, more recently, volatility has minimum variance portfolios have been the most impressive performers of late, but you will see that the cap weight performance, which is the basis of the broad market indices that are market capitalization weighted, doesn't actually come at the top of these various methodology performances, at least during this time horizon. So when you're talking about the benchmark that you're going to use, you have to also talk about what construction methods you're going to bring to the table as well. Notice there that equal weighted is also performing very well of late. And there's a lot of debate in terms of what I talked about earlier and modern portfolio theory and what the optimal portfolio is, on effectively what happens with regards to, can you actually really estimate that optimal portfolio, and isn't it better to just select an equal weighted portfolio? And that debate is still ongoing. So let's just focus on the broad-based market indices. The broad-based market indices are effectively taking the universe and sampling that universe down. You'll notice it's not in itself optimal. Why? Because it's only representing 75 to 95%. It's still missing out some part of the universe. In this case, perhaps the smaller boxes there at the end. And so in that respect, it is a good representation. It is a good market proxy, but obviously it is not all traded assets, which is what the capital asset pricing model suggests is optimal. You'll all know what the leading broad-based indices are. S&P, Dow, NASDAQ, Euro Stoxx 50, FTSE 100 in the UK, CAC 40 or whatever. So this is just a screenshot from Bloomberg that obviously shows that. And as we know, these numbers are reported daily in the press. But as I said, when we were going through the other sorts of benchmarks, there are also effective group benchmarks. How do you perform against your peers? Now, as you can see from the spider web diagram here, it is not optimal to use this. Why? Because collectively, your peers could all maybe underperform an index, or majority of them could underperform an index. So chasing your peers' performance isn't necessarily conducive to actually delivering the best performance. It's merely delivering a performance that aids your marketing effort. And it has a number of drawbacks. The drawbacks of a peer group benchmark are that, unlike an index, a broad market index, your peer groups are subject to their fee. So in other words, the performance of a peer group benchmark is held back by the fee that are charged on the underlying funds. And obviously the fees differ between the various funds, and that is something which it is far better to state gross of fees than net of fees from a point of view of creating a level playing field. In terms of peer group benchmarks, you can further divide it down here. There's a diagram showing value, growth, quality, volatility, momentum, even an ESG peer group analysis. And you'll see that the small dot on each of the performance of these various quadrants sometimes doesn't measure up to the benchmark. Sometimes it outperforms the benchmark, thereby illustrating the problem that I just earlier alluded to. I mentioned returns-based ratios, and this links back to what I was saying about modern portfolio theory, and effectively the slope of the line that effectively transacts against your portfolio is the Sharpe ratio, and that effectively links your return on your portfolio, which you subtract your risk-free rate over the standard deviation of the portfolio's returns. In other words, it is a risk-adjusted return ratio. Obviously, this tells you nothing about the accessibility of the instruments or effectively about the how representative the sample on which it's been measured. So in other words, although it's linked to modern portfolio theory and very good science in that respect, it isn't actually an optimal index on which to base returns on, but it's a very useful measure to be used in the analysis and comparison between funds. One thing that impacts quite a lot how you perform on something like a Sharpe ratio is how active a fund manager is. And in this respect, the active share of a fund manager is determined by, as you can see from the diagram, which shows active share against tracking error, in other words, against how far you diverge from an index, is based upon a number of characteristics, whether in the right-hand quadrant you have a concentrated stock pick, or whether in the bottom left-hand quadrant you're a pure indexer. Obviously, there are some people out there who are closet indexers. They're running very low tracking errors and are effectively hugging the benchmark, as we call it, and they are also pretty close to the left-hand lower quadrant. If you're diversified with stock picking, you're up there in the sort of more focused high active share with the lower tracking error. And obviously, if you're taking things using, as I explained, factor-based approaches to breaking down the factor risk in the market, then obviously you're running high tracking error, but you are actually focused on stocks with certain attributes that are in the index, so you have lower active risk in that respect. So what do people actually out there actually do? Well, there are actually more benchmarks than there are fund managers in the world, a rather concerning number. There are 3 million benchmarks out there at the last count. In fact, the number of people benchmarked to the FTSE 100 in terms of funds, essentially very large focus from the open-ended funds community. Bear in mind that an institutional fund is probably more likely, if it's large, to be indexed to something like the MSCI because of the depth of that, the FTSE 100 only having 100 stocks. So again, in a benchmark, the number of stocks you have in the benchmark, your investment universe, is also very relevant. The flip side of return, the Sharpe-based measures, are the risk-based indices, like, for example, Trainer, risk being characterized by the portfolio's beta. And again, you'll see, once again, this tells you nothing about the instruments themselves or whether or not it is can be a representative sample. That said, it is also, again, as Sharpe is useful for comparison between funds, and if used together, gives quite a lot of explanatory information about the underlying funds which you're comparing. But all of these return and risk measures can be impacted by the market concentration. If we take a look at what's driving US markets at the moment, what we have is what's come to be termed the FANGs, but essentially stocks like Microsoft, Apple, and Amazon, if you take their combined market capitalization, their combined market capitalization of those three companies is more than the REIT sector, more than the energy sector, or even more than the material sector. So actually, they are a significant sector, if you want to call it that, in their own right. So drilling down, and I've talked a bit about factor-based indices. Factor-based indices, as you can see, are a bit more useful than the risk-based metric like Trainer. Why? Because you know what the representative sample is, and you know that those samples are accessible, again, focusing on the points on the Likert scale shown by the spiderweb diagram. And that allows you to slice and dice portfolios much better, which means that if you have a clear top-down strategic view and you want to what we call tilt a portfolio, a factor-based index will help you measure the success or other of that portfolio tilt. Again, you might not want any of these indices because why? Essentially what you're doing is with a portfolio is trying to match your long-term liabilities with your long-term assets, and in that respect you want to over time reflect the fact that your liability is changing over time, as is shown by this chart here, which shows that actually the makeup of your asset allocation as you progress over a number of years, in this case 45 years, changes over time because the nature of the risk return required to match your liabilities changes over time as well. So obviously if you make a custom-made index, as the Likert score shows here, you're really very representative. You are delivering what you want, but obviously you fall back on a number of other things, like, for example, it's not as objective. It's not based upon modern portfolio theory as such, and therefore a lot harder to argue. So you get more precision, but that precision comes at the cost that you are being less scientific in the management of your assets. Likewise, is it useful to academics? No, it's not, because it's customized to you and your particular approach. A lot of people use these, obviously, because all investment mandates are different, and some have very specific goals. And indeed, custom indices are used a lot in the ESG world, environmental, social, and governance, which again I'll come on to at the end. So what about the use of equity indices as benchmarks? As I said, these are typically the most widely used and are derived from Markowitz theory and portfolio theory, but link in with what I've said about return and risk-based indices like Sharpe and Trainer. So they are academically important as well, which gives academics the ability to effectively test the long-term performance and outperformance, underperformance, but also persistence of that performance over time, which allows us to understand whether or not skill is something that is being brought to the table by fund managers. And again, that's a discussion for another webinar. So essentially, an index is just an exercise in sampling. You are reducing the investment universe, but you need to reduce that investment universe in a proportionate way so that you're getting a reflection of what you need. So in other words, you have to worry, as I said, about the number of assets, but also the selection criteria for inclusion of those assets. And as I said, the weighting schema, equal weighted or market capitalization weighted, or even many other potential schema. At the same time, marketplaces are dynamic, they change all the time, they adjust and so forth. You need to have effectively rules for index adjustment. A rights issue, there are more shares in existence. The company may get taken over, comes out of an index and so forth. How do you handle that and how do you approach that? Likewise, what about periodic cash flows? If you're in a mutual fund, you've got cash flows every day for an index or whatever. How do you go approaching that if you're, for example, creating an ETF which is mimicking that index? So a number of interesting approaches that fund managers themselves need to improve their science. And also treatment of tax, for example, if you've got private client indices, which is a customized approach to managing an index for a private client. Obviously, because they're subject to taxation and some institutions are not. So let's talk about how you slice and dice. Effectively, the benchmark allows you to break down your policy returns, and it allows you to break down your policy returns between the actual portfolio return, but also your timing, when you're getting into your policy benchmark and how your timing is affected by that. How you're shifting, for example, between bonds and equities over time if you have a benchmark that is customized between those two. But obviously, security selection comes into it because your portfolio is not going to hold all the securities in the index or benchmark, unless, of course, it's doing a replicated strategy. So you have a policy security selection return element, but also you have a policy return, which is the passive portfolio benchmark. You've got your effectively your active or non-active risk in that instance. When you invest internationally, the additional component of currency returns come into it. And again, this is a very big field and I can't cover it in just one slide. So I thought what I would do is just illustrate that over time with a portfolio, this is based upon quarterly returns of MSCI in the EAFA portfolio versus one which isn't hedged. You'll see that actually this is to some extent something that balances out over time. There are some people that say that currency hedging is a zero-sum game. Obviously, you can get alpha from your currency decision or whatever, but you can measure that with an unindexed, an unhedged index. So as a result, you can still work out what your policy return is from currencies without necessarily having a hedged index. So my preference would be not to have a hedged index, but obviously I understand why some people do, because obviously your ultimate liabilities in many instances are in your domestic currency. I mentioned fee, and fee does actually really impact performance against an index. So obviously the portfolio managers are taking a fee for their deliverance of their returns. And again, this is really more of a sort of critique of the peer group approach because they obviously are subject to fees. But one of the biggest impediments to outperformance and persistence of outperformance of active managers against an index is the size of the fee, which is really what this Morningstar chart is showing. And again, these slides are going to be available for you afterwards to look at in your own time. So I mentioned that, in fact, I showed the performance of the chart of equal weighted, market cap weighted, and a number of others. And obviously equal weighted is, as its name says, your weights are equal, and your market cap is based upon how big your company is in terms of its size of the shares value, and is calculated. There's a whole number of different calculation approaches, but I've just put one here because that's the one that is widely recommended by the investment industry and by global investment performance standards, of which the CISI obviously endorses. In that respect is the method that is most appropriate from the investment point of view of providing a level playing field in the performance of your indices. Then you need to identify the asset universe, and the traditional way of doing this is through the covariance of the stocks. That then resulted in their GICS classification, in other words, their sector classification. Over time, the covariances have moved very differently from the GICS. The GICS is far more slow moving because obviously once you've assigned a sector to a stock and that stock changes what it does, it takes a lot of time for the GICS classification to change over time. Bear in mind that when it started, for example, Nokia in Finland was actually a company that was focused on forestry, and only subsequently became a mobile telecom company when they worked out a way to devise communication between their diverse forest assets over wireless. So companies change over time and GICS changes very slowly. What changes most rapidly is natural language processing, NLP, which is a new approach to looking at various indices. And if you remember what I said about certain stocks, like for example, Amazon, Google, or whatever, what are they actually? If you look at what they are from a language perspective, these are actually retail stocks. And as a result, if you classify using NLP, you come to a very different weighting, as can be seen from the far left, than you would get from GICS or covariance. And in fact, if you used an NLP weighting in the current market environment, you would be doing very well relative even to the index funds that are focused on GICS right now, even though GICS has a high IT content. So the index effect, obviously, in that respect, because now so much is indexed, a passive investment, the index effect really has a big impact when stocks come in and out of the index. And so in this respect, this shows the index effect of shares coming out on the first day of exit, sorry, after the first day of trading, after being named to enter the S&P small cap index, and you can see the outperformance there of the various stocks. So you can see some very dramatic changes. Obviously, because this chart shows small cap, those changes are more pronounced, but even so, there is so much passive money going into it that when Fresh Del Monte came into the small cap index 600, which isn't the most widely followed index, there was a 20% jump in the price. So there are distortions from the fact that modern portfolio theory suggests that this is where funds should be focused. So active managers need to be able to articulate this, because obviously they're in competition with the passive funds for assets, and obviously to do that they need to identify and make clear that there are some failings in effectively indexation as an approach. There are obviously many strengths, which is why so much money goes into it. The way that you obviously look at performance relative to an index is through tracking error, and the tracking error is the divergence between the price behavior and position or portfolio and the price behavior of a benchmark. The calculation, there are two calculation methods there, but the most commonly used one formula is on the bottom right. But obviously tracking error can be impacted by a number of things, including, for example, your concentration of your portfolio, your active share, but also which index you're benchmarked against, which is why index choice is so important. And in that importance of index choice, let's go right way back to the dot-com bubble, which, as you know, if you were benchmarked against the S&P 500, which had a very big technology component at the time, but on the other hand, if you were benchmarked against NASDAQ, you would have enjoyed the run-up, but you would also sadly suffer the decline of asset values from the bursting of the dot-com bubble more than others. And obviously, the choice of benchmark in that instance would have really impacted the way that your performance over time was reflected. So I said that benchmark uses are also to determine things like fees as well, give manager guidance, and in that respect, they're widely used by hedge funds, where hedge funds take a performance fee, 20% of the outperformance of a benchmark, actually 20% of the outperformance of a self-selected benchmark, and all the earlier provisos I said about benchmark selection apply to that as well, because obviously the risk of misspecification of benchmark, but obviously one thing that investors can do to avoid obviously being taken for a ride in that respect is to insist on what's called a high watermark, and this chart just demonstrates how a high watermark works against the benchmark. So much as a ship going up and down in the water, if your performance hurdles are met, if you then decline, you have to re-reach the new high watermark before performance fees start to become paid again in the new period. Constituent turnover is very important as well, because stocks have to be, indices have to be rebalanced, and stocks come in and out of the various indices. And here I've just shown an example of Paul Marks and Spencer's coming out of the indices and the new constituents going in, and obviously the dramatic impact of the new constituents going into the FTSE 100, and what you can imagine your attributed difference if you had not made the relevant call against the stock that was either coming in or going out of the index at that time. So let's drill down into a more unfortunate example. You know that Wirecard in Germany was a giant corporate scandal, a traditional sense, a case of accounting fraud. But actually, Wirecard replaced Commerzbank in the DAX, one of the largest banks in Europe, and in that respect, clearly that wasn't a good outcome for investors. So being in an index in itself doesn't say anything about the quality of the investment universe of the stocks in the index. Likewise, when stocks come in and out, they create a large amount of turnover purely because of this weight of money. And here I just highlighted in red what happened when Poland became a developed market. And as you can see, a giant surge in volume. So these distorting effects do take place. Take, for example, South Korea. South Korea is a developed country, but it's still a very large part of the emerging market index, most indices. When that gets officially announced as a developed market, that will become the biggest portfolio trade in the history of the world, because essentially you're talking at a massive weight in emerging markets that will cease to be benchmarked to them, that will then become benchmarked to developed markets. And it will be very destabilizing, which is why they haven't done it yet. There are plenty of discussions about this, but obviously one has to worry about the integrity of markets as well. Size effect, a well-known effect in finance, obviously, again, your choice of benchmark should reflect, obviously, your choice of investment style and what sort of size of market capitalization companies you are looking at. At the same time, style drift happens over time, and in fact, style drift also happens in indices as well. And I've just highlighted that here, so that obviously, if you've got a fixed style and the index is moving away from you, that also has implications for benchmarking and integrity of your choice of benchmark. I wanted to say a bit about environmental, social and governance, and in that respect there are a multitude of ways to break down and determine what an ESG index is. There are negative screenings and there are positive screenings. Negative, you take bad companies out. Positive, you try to focus on impact and include the good companies. But there are as many approaches, as you can see, well, a large number of approaches, as there are opinions of what is good economic, social and governance, and a lot more work needs to be done on this. And that's some of the work that we are doing at Strathclyde, because we are looking at, as I explained earlier, NLP, natural language program, to look at how stocks in ESG are grouped from the point of view of language, and therefore get a better understanding of their ESG impact by the way that the various variables change over time. So just to show the importance of that, I've just highlighted from the report and accounts of the last report and accounts from General Electric. And here you can see, I've marked with a little cross, that military in terms of their turnover is slightly over 4 trillion of turnover. But in that respect, it is still less than 5% of their turnover, and therefore is not included in various indices because the indice cutoff is 5%. So if you are investing in an ESG fund with a cutoff of 5%, you could still be investing in one of the largest weapons producers in the world. So again, construction methodology is very important. Just very quickly, 3 case studies. What about commodities? Commodities are benchmarked against financial futures because you can't take delivery of the underlying commodity, and that means that they are not based upon a consumption cycle but a production cycle, so present very different issues, and they have issues like, for example, the roll yield of the futures. The futures expire and then have to roll over into the new ones. Those all create index challenges, and again, that's an area of research that we are looking into. Likewise, hedge funds, there are so many different styles. The chart here shows all the different approaches and classifications of hedge fund styles. As I said, it's very important for a hedge fund to benchmark correctly because they're taking the fee off that, but what is a correct benchmark for a hedge fund? And surprise, surprise, they typically use peer groupings, and as I explained, peer groupings have problems because obviously they are a net of fees. Real estate, I still am baffled as to why there hasn't been a proper real estate futures market with proper depth in the world, considering the importance of real estate to our economies. But either way, part of that is that there isn't liquidity, and the only way to get liquidity from an equity market perspective is to go to REITs, the real estate investment trusts, which are largely US based. And in that respect, when you drill down into those, you find that they're not necessarily, because they're corporations, representative of what's going on in the underlying market. So therefore, we are still defaulting to the Case-Shiller Index in the States, and in the UK, the Halifax House Price Index, which again have methodological issues because they're based upon actual physical sales, and property itself obviously doesn't change hands as often as we would like to create a proper price indices. Some final words on the Global Investment Performance Standards. As you heard, there are lots of ways to slice and dice a benchmark and an index, so there are lots of ways to misrepresent, and you can also misrepresent from periods and snapshots. So that's why it's incumbent upon the industry to have a level playing field, and that's what Global Investment Performance Standards does. And in that respect, I think that this is one of the great achievements of our investment profession over the last 30 years. This slide is just a repetition, and so I move on to the conclusion. The benchmark choice matters, and so hopefully what I've explained has made that quite clear. You can see here from 2 distributions of returns that actually the benchmark, the dotted line, can be in different places depending upon the nature of the return time series. So the nature of the return time series and the correlations matter. as does the index construction methodology, as I explained. So does style characteristics, because you can slice and dice risk and the risk exposure of markets in different ways. And that comes down to, once you've effectively worked out how you're going to go about indexing something, then how your active share to that, and how active you are as a manager or how passive you are as a manager. And as I said, I strongly recommend having a level playing field.